When we talk about valuing a business, there are a lot of terms thrown around. DCF, PE, book value, and more. But did you know that almost every valuation method you've heard of falls into just three main categories? Let's break them down. 1. Intrinsic value, the cash flow approach. This is the most fundamental method and often the most detailed. Here, we value a business based on the cash it generates. The most popular method under this approach is the discounted cash flow, or DCF. In the DCF method, we forecast the free cash flows the business is expected to generate in the future, and then bring them back to present value using a discount rate. But what exactly are free cash flows? They're the cash left for the owners after all operating expenses, capital expenditure, and working capital needs are taken care of. Now, these cash flows can be of two types. Free cash flow to firm, FCFF. Free cash flow to equity, FCFE. The difference: FCFF is before payments to debt holders, while FCFE is after. Which one do you use? Well, if you're valuing the entire company, you use FCFF. If you're valuing just the equity shareholders, you use FCFE. Once the cash flows are forecasted, we discount them back using either the cost of equity or the weighted average cost of capital. This depends on if we are valuing the whole company or just the equity. Now here's the thing. DCF requires a lot of assumptions: growth rates, cost of capital, market trends, and more. It's a powerful method, but only if you really understand the business, the industry, and the economic environment. 2. Multiples valuation. The comparables approach. This one's more intuitive and faster. In the multiples method, we take a company metric like earnings, revenue, users, or EBITDA and multiply it by a market-based multiple. This multiple is often taken from comparable companies or industry standards. A classic example: the price-to-earnings ratio, or PE. Let's say company A has earnings of 10 per share, and the industry PE is 20. That gives us a value of 200 per share. You'll also see this with revenue multiples for startups, like valuing a company based on the number of users or revenue run rate. This method is fast, but remember, it's only as good as the comparables you're using. 3. Book value or liquidation approach, the asset method. This is the most basic form of valuation. Here, we look at the value of the company's assets and subtract any liabilities. There are a few ways to do this. Take the value of assets as recorded in the books. Estimate what they'd fetch if the company were liquidated, or calculate how much it would cost to replace those assets today. This approach is useful for asset-heavy businesses or in cases of liquidation and distress sales, but it doesn't capture the value of future growth or intangibles like brand or IP. Bonus: contingent claim or options valuation. Sometimes we need to value something that depends on a future uncertain event, like a patent, a startup's pivot, or a mining license. Here, we use a technique similar to DCF, but with a twist. We calculate the expected cash flow, and then multiply it by the probability of that event actually happening. So to recap, almost every valuation method falls into one of these three categories. 1. Intrinsic cash flow. 2. Multiples, market comparables. 3. Book value, asset-based. And occasionally, we use real options for special cases. Do comment below if you need a detailed video on any of the three valuation methods.